Hey everyone, hope you're doing well today. So, something big just happened that could affect a lot of things in your financial life. The Federal Reserve cut interest rates. And it is important because this change has the potential to impact everything from your savings account to how much it costs to borrow money for a car or home. And here's something a lot of people don't realize right away. Lower interest rates aren't just about making borrowing cheaper. They also send a signal about the overall health of the economy. When the Fed lowers rates, it's usually trying to encourage more spending and investment, which means they're confident we're in a pretty solid place. But there's a lot more to it. So stick with me because understanding how this works can help you make smarter financial decisions moving forward. So what exactly does a Fed rate cut mean for you? Let's break it down, starting with something that hits close to home for a lot of people: mortgage rates. If you've been thinking about buying a home, you may have noticed how crazy things have been with prices and interest rates over the last few years. Well, a rate cut could be the thing that finally brings some relief. Lower rates often mean cheaper mortgage payments, and for those of you who've been waiting to buy, this could be a big opportunity to get a more affordable loan. But, and this is important, it might take some time before we actually see mortgage rates drop significantly. So, don't expect an immediate change, but keep an eye on it over the coming months. And if you're already a homeowner, this could still be good news for you, especially if you've been thinking about refinancing. A lower interest rate might mean you can cut down your monthly payments or pay off your loan faster without those extra interest costs piling up. Again, timing is key here, so make sure you stay informed about what's happening with rates in your area. Now, speaking of loans, let's talk about something that doesn't get as much attention: car loans and credit cards. With a rate cut, borrowing costs go down, which means it could become cheaper to finance a car. If you've been thinking about getting a new vehicle, you might see lower monthly payments because of these new, lower interest rates. On the flip side, though, credit card rates are usually a bit trickier. They don't always fall in line with the Fed's moves, so if you're carrying credit card debt, don't expect those interest rates to drop overnight. But it's always worth checking with your card issuer to see if there's any movement. Now, here's something that might surprise you. The Fed rate cut doesn't just affect loans, it also has an impact on your savings. I know a lot of you have been enjoying higher interest rates on savings accounts and money market funds lately, which is great for growing your emergency fund or stashing away extra cash. But with rates going down, you might start to see those interest rates dip a little too. So, if you've been relying on that extra bit of interest to pad your savings, this might be the time to think about where else you could park your money to keep earning a solid return. And that brings us to the stock market. Some of you might have already noticed a bump in stock prices before the Fed's announcement. That's because lower rates make it cheaper for companies to borrow money and invest in growth, which is typically good for business. As a result, we often see stocks go up after a rate cut. But, and this is important to keep in mind, markets can be unpredictable. Just because stocks are doing well now doesn't mean they'll keep going up. So if you're investing, it's still important to think long-term and stay focused on your overall goals. Another thing to consider is inflation. Now, the main reason we've been seeing these interest rate cuts is because the Fed believes inflation is finally under control after those massive spikes we experienced over the past few years. But don't expect prices to go back to what they were before the pandemic. Some things, like housing and food, might still be more expensive than they used to be, and that's partly due to factors outside of monetary policy, like supply chain issues and climate-related events. So, while lower rates are a sign that inflation is stabilizing, it doesn't mean everything will suddenly get cheaper. And let's not forget about the job market. One of the big reasons the Fed decided to cut rates is to keep the labor market strong. When borrowing costs are lower, businesses can afford to invest more, and that often leads to more hiring. If you're looking for a job or thinking about switching careers, this could mean more opportunities on the horizon, especially as companies take advantage of these lower rates to expand. But like with housing, it might take a little time before we see the full effects. So, what does all this mean for you and your money? Well, it depends on your situation. If you're looking to buy a house, refinance your mortgage, or take out a car loan, you could see some significant savings. If you're an investor, you might see some short-term gains, but remember to keep your eyes on the long game. And if you've got money in a savings account, it might be time to explore other options to keep your returns solid as interest rates dip. The key takeaway here is that lower interest rates can create opportunities, but they also come with some trade-offs. So, my advice is to stay informed, weigh your options carefully, and don't rush into any major financial decisions without doing your research. And if you've got any questions or thoughts on how this rate cut might affect your personal situation, I'd love to hear from you. Drop a comment below, and I'll do my best to answer as many as I can. Thanks for watching, and I'll see you next time with more tips on making the most of your money.